Greetings of the day. Welcome to Chapter 8 Life Insurance Products of IC01 book Principles of Insurance. Basically, this chapter we are going to discuss various products offered by life insurance companies. You see, you can have always choice of life insurance or general insurance as your career. So life insurance companies, they offer various products which is covering the risk of dying early or living too long. You can always get the pension. If you die early, your family will be getting, considering how much you are insuring it. So you are going to learn about the products offered by life insurance companies, which pay only on the death of the insured during the policy tenure. These are known as the term plans, and products which pay only if the insured does not die during the policy tenure, which is also known as the pure endowment plans. So life insurance companies also offer a lot of other plans under the various names, which are a combination of the above two basic plans, that is life and total, if you live long. You will learn about the all these products and other products offered by insurance companies during my discussions of this particular chapter. So there are traditional products offered by life insurance companies. You should understand the features of the linked policies. You also understand the features, annuities, and the group policies. These are very, very important. This is basically chapter devoted for the life insurance products. We have to understand the classification of insurance business. Basically, insurance business is classified into two groups, we can say two disciplines. One is life assurance and other is non-life insurance. The life insurance takes care of the life of a person, the life of a, it can be a group, from the company's point of view, they can also take a life insurance of their uh, the people, those who are working with them. The non-life insurance is also taking care of various assets. You have money, you have material, you have machineries, and sort of things. All these 4M, uh, uh, like your buildings and your plants and your cargo which is in transit, your vessels, your automobiles. All these things can be insured in the non-life insurance policies. You should understand basically what is the products. So products offered by life insurance companies, you should know that they are the products, usually they are referred as the life insurance plans. These plans have either or both basic elements, death its benefits. So this is giving a death benefit, that this is also known as a death cover. It is payable on the death of the insured during the tenure of the policy. Basically, it takes care of the, the family of that particular person. He is taking a life insurance, so after his death, the whatever premium he is contributing, based on that, the family members, they get the payment as per the plan what he has selected. The other is survival benefit, pension benefits, survival benefits. The person, nowadays the longevity of the person is quite increased, and then definitely there are various companies, they do give pension, but there are various companies they do not give pension. So there are, after retirement, a person is saving in such a way that after retirement he would get some benefit, direct benefits, continuous and direct benefit. So these are also known as the survival benefits. So what are the survival benefit? This is also known as a maturity benefit. It is payable on the maturity of the policy if the insured person survives in the entire tenure of the policy. So this is very, very important, that there are various plans. There are certain plans that you keep on paying premium, you would get some amount after 5 years, and then some amount after 10 years, some amount after 15 years, 20 years, something like this. Because as we are advancing, our requirement of money is changing, maybe the marriage of daughter. So like that, it can be planned in such a way that particular period you will be having certain amount of the amount uh, based on your life insurance plan, the maturity benefits what you have selected. So we have to see the different types of life assurance plans. So in the life insurance, you will find either there is a term assurance or there is a endowment, which is known as a pure endowment assurance. The, so this can be further divided into whole life assurance. Then it is having money back insurance, and then this is having a endowment assurance. So term assurance plan, which is this is it is taking takes the insurance, the term insurance plan for a sum assured, which is a death cover of rupees 15 lakhs for 20 years. This is example, for the annual premium will be rupees 10,000. The policy is specifying that if the, say for example, if Mr. Wasim is dying anytime during the 25-year tenure of the policy, the insurance company will pay the nominee, the beneficiary of the sum assured death cover of rupees 50 lakhs rupees. Now you just see how much he has taken a 25 years policy, and per year it is going to be a the premium is going to annual premium is going to be 10,000 rupees. 10,000. So this is based on a term assurance plan. The pure endowment plan will be, say for example, Ashok is taking a pure endowment plan for the sum insurance survival benefit of rupees 50 lakhs for 25 years. The policy is specifying that the survival benefit around rupees 50 lakhs will be paid at the end of 25 years if Ashok is surviving the entire tenure of the policy. See, the Ashok is taking this particular policy, so he knows that the considering the lifestyle, etc., his longevity is there for more than say 25 years when he takes the policy. After 25 years, there is every possibility he may retire, and then he wants the money. He can again fix that money in such a way he would get a fixed the interest by which it can be, it will give him the benefits like a pension plan, something like that. So there are different type of plan. One is pure endowment assurance, and other is a term assurance. So you should know about. Really, we have seen, term assurance, pure endowment assurance, whole life assurance, money back assurance, endowment assurance. So whole life policy, it is a term insurance plan, which is an unspecified period is called a whole life. In whole life, the period is not specified, till your death. So that means in this you will not get the personally benefit, it is only after the death. So this policy can extend even up to age of 100 years of the assured person. Under this policy, the sum assured is paid on the death of the policy member, whenever it happens, Whereas the other money back policy, it is a condition of term assurance plan, and it is a multiple pure endowment plans. So there are various plans, you should know about it, but basically try to understand that it is a whole life insurance, it is a money back assurance, and then it is a endowment insurance. Now we can see the features of traditional plan. So the life insured person, he can be individual adult, he can be a minor, or he can, you have two or more people jointly under one particular policy. Of course, you should have an insurable interest. Whenever you are taking a policy for minor or a spouse or anybody, you should have a insurable interest. So minimum and maximum sum insured can also be defined. Many plans you will find they will stipulate minimum sum assured amount, and some plans will specify the maximum sum assured plan. Some plans don't specify any maximum sum assured, but this is subject to underwriting. There can be limits on riders also. So sum assured payment, the plan specifies when the liability will arise on the insurer to make payment. This can be on death of the life assured, or maturity of the plan, some contingency is stipulated in the riders or on some other dates. This particular plan also specifies whether the sum assured payment will be made lump sum or in the installments. So these are the very important features of uh, the traditional life assurance plan. So you should know that the minimum and maximum entry age also can be specified in the policy. The plan specifies the minimum and maximum entry age. Majority of plans also specify the maximum maturity age, while whole life plans go until the life insured survives. So minimum premium amount. So some plans specify the minimum annual premium or the minimum installment premium. So plan tenure, the plan specifies the minimum and the maximum policy tenure, that is a duration. The tenure is a duration of the particular policy. So whole life plans go on till the life insured survives. Some plans provide benefits even beyond the policy terms. So this is very, very important aspects of this life insurance plan. See the premium payment frequency. The plan what you are selecting will always specify the options available for premium payment frequency. It could be monthly, it could be 6 monthly, it could be annually. The option can be monthly, quarterly, half yearly, yearly, or a single premium. So some plans provide for premiums to be paid for a period less than a term. So some assured step up, step down options. Some plans provide the options of increasing the sum assured during important events like marriage, purchase of a house, childbirth, or certain policy anniversaries. This happens due to participation in surplus and bonus additions or due to guaranteed increase. Some plans also provide the options of reducing the sum assured during events like reduction of liabilities. Under the mortgage achievements of certain milestones, objectives of certain policy anniversaries. There are various riders. Some plans offer additional or supplementary benefits by way of riders in addition to basic cover which is provided in the policy. See, there is a unit link insurance plan. This is the investment link or unit link insurance plans. So you can have a choice of funds. It can be equity funds. It can be a balance fund. It can be a money market fund. So the choice is yours. You can select the way you want it. So if it is a investment, the major portion of the premium is in equity and equity related instruments. They are what you say secured. They are insured. The invest or major portion of the premium is fixed in the in fixed income security. So which security equity you are selecting or a fixed income securities you are selecting, or it can be a invest. Major portion of premium is mixed. It could be equity and debt both. So there are various type of things. Say for example, somebody is investing the portion into debentures or into the share market or something like this, or it could be a mix. It will have the security, proper security for the funds where we are selecting the unit link insurance plan, which can have the it can have invested major portion of premium in the instruments such as treasury bills, certificates, or deposits, etc. There are various type of schemes. Government is also giving. There are bonds which are raised, and there also it can be having from government fixed income, and then it is linked with that fixed income plan. So this is very important. So this unit link insurance plan, it can be the ULIP premium. Whatever premium is collected, it is divided into three parts. One is expenses. Other will take care of the payment at the time of mortality, and otherwise third is the investment. So there is a fixed income at the time of death, and then there is also investment. So you can always get more than what is the link with the death premium. So basically, the claim settlement in ULIP, that is a unit link insurance plan, the plan is covering the risk of providing a protection to the life insured. The second plan acts like a mutual fund where the life insured can make regular investments. On maturity of the plan, the fund value is whatever is the fund value will be paid. On death of the insured during the tenure of the policy, either the sum assured along with the bonus or the fund value, whatever is higher will be paid. So if the fund value is less, then whatever is the death premium, the death sum insured, that will be paid. Some insurance companies have provision to pay both. So of course it depends upon the plan what the assured is selecting. The life assured has a choice of switching or redirection of the plan. So the life insured can transfer their existing investment from one fund to another fund during the tenure of the policy. See, this process is known as switching. The life insured also has the option to invest their new premium money after deduction in a fund other than the fund which has their existing investment. This process is known as a redirection. In the unit linked insurance plan, the policyholder chooses the fund in which the money is to be invested. So the risk of the investment is borne by the policyholder and not the insurance company. In ULIP, sometimes there is a risk of capital loss as financial markets are expected, they are exposed to price fluctuation. You should understand the features of annuities. So it is an intermediate annuity in which this type of contract, the annuitant makes a lump sum payment to the insurance company and the insurance company starts paying annuities. So that is a period of payments soon after the policy commences. Then there is a deferred annuity. So that is here the annuity payments start after the specified period. This time period is known as the deferment period. In deferred annuities, there are two scenarios. In the first scenario, the annuitant makes a lump sum payment and the insurance company starts paying annuities after specified period. In the second scenario, the annuitant keeps making periodic payments to the insurance company for a specified period and the annuity. So payment starts after the deferment of period. So what is the frequency? What is the frequency of annuities? So the plan which can be offered by insurance companies give the annuitant the option to receive the annuity premium monthly, quarterly, half yearly or annually. So policy tenure, the annuities may continue as long as the annuitant is living or for the minimum specified period and thereafter till the annuitant leaves or till the last person among the joint annuities dies. What are the group policies? The group policies offer benefits to large number of persons through one policy. The single policy covering multiple people is known as the master policy. It is insured in favor of the person representing the group of beneficiaries. Group policies can be issued to employers representing companies, organization, professional association representing groups such as an association of lawyers. It can be given to the trade unions. It can be given to the banks or the loan annuity holders, any other professional organization representing a group of people brought together for the common objective. So there are various group policies. I think when I was in Indian Navy, we were also covered for our life in case of any eventualities or death during the service period. We were covered, and the Indian Navy was paying premium for that particular period. So naturally, those who are in services, the every year or every monthly, they will be changing the group, the number of people those who are covered under the policy. So what is the frequency? What is the frequency of annuities? So the plan which can be offered by insurance companies give the annual the option to receive the annuity premium monthly, quarterly, half yearly or annually. So policy tenure, the annuities may continue as long as the annual is living or for the minimum specified period and thereafter till the annual leaves or till the last person among the joint annuities dies. What are the group policies? The group policies offer benefits to large number of persons through one policy. The single policy covering multiple people is known as the master policy. It is insured in favor of the person representing the group of beneficiaries. Group policies can be issued to employers representing companies, organization, professional association representing groups such as an association of lawyers. It can be given to the trade unions. It can be given to the banks or the loan annuity holders, any other professional organization representing a group of people brought together for the common objective. So there are various group policies. I think when I was in Indian Navy, we were also covered for our life in case of any eventualities or death during the service period. We were covered, and the Indian Navy was paying premium for that particular period. So naturally, those who are in services, every year or every monthly, they will be changing the group, the number of people those who are covered under the policy.